Legendary value investor Warren Buffett has just updated his portfolio. I've been through the whole thing, so you guys don't have to. And in today's video, I'm going to show you the top 6 value plays within Warren Buffett's portfolio based on a wide range of financial modeling of the companies. Buffett's Apple sale brings value back to quality investing. The Oracle of Omaha's latest portfolio reshuffle is a warning against investing at any cost, and you're going to find out exactly what that's referencing later on in the video. Warren Buffett's longtime business partner Charlie Munger brought quality to value investing. Now Buffett is bringing value to quality investing. Berkshire Hathaway Inc.'s annual meeting in May, Buffett revealed that he had trimmed his stake in Apple Inc., inarguably one of the best businesses in the world. Buffett reassured the Berkshire faithful that he is no less enthusiastic about the company, calling the iPhone one of the greatest products of all time. So that begs the question, why, if it's one of the greatest products of all time and you love the company, why would you sell Apple stock? And he sold it in quite a substantial amount, as we're about to see. So if you come and have a look at Warren Buffett's new portfolio, you can see the different changes, the position size, the number of shares, and then you can also see in the middle column the position size change and also the number of shares change from the prior portfolio. You can also see the position size change as a percentage and the number of shares change percentage. And if we look at the very top line, you can see the massive sale of Apple shares. And if we return to the Bloomberg article, you can see this graph posted in the article showing the price to book ratio and also the forward 10-year total return of high profitability stocks. And what you can see here is that as the price to book ratio increases, you start to see forward 10-year total returns diminish. In other words, the more you pay up for a stock, the less you should expect to get back. And this really is the basis of value investing. When it comes to high quality stocks, in other words, the more investors pay, the less they should expect to earn. So this methodology is really what has made Warren Buffett one of the most, if not the most, legendary investor in the financial space. And value investing was pioneered by Benjamin Graham, who was a mentor to Warren Buffett. And Warren Buffett's key principle has always been to find high quality stocks and to buy them when they are undervalued relative to their intrinsic or fair value as a company. Here is a list of some of the key principles that drive Warren Buffett's portfolio selection process. But for the purposes of today's video, I just want to pick out 2 of the most important ones based on what we're going to be looking at. The first one is number 2, value investing. Buffett seeks out companies that are undervalued relative to their intrinsic worth. His investments are often in businesses with strong earnings potential, solid management, and competitive advantages that allow them to withstand economic downturns. Number 6, margin of safety. A critical component of Buffett's strategy is ensuring a margin of safety when investing. This means buying stocks at prices significantly below their intrinsic value, which reduces risk and increases the potential for returns. So Warren Buffett's portfolio that we're going to be revisiting shortly has already been constructed with these key principles in mind. And now we're going to go and have a look at 6 of the best value plays within this value themed portfolio. So let's go back to Warren Buffett's portfolio. And the first question, of course, we need to answer is, why did Warren Buffett sell his Apple stock if he loves it so much? And the answer is very simple. When we run various financial models on Apple's financial data, you can see, taking the prior close at 221.72, Apple is trading around 26% over its intrinsic or fair value, which based on multiple financial models sits at around 175.68. Now worse still, if you look a little bit lower to FV1SD upper and FV2SD upper, these are 1 and 2 standard deviations above Apple's intrinsic fair value at 175.68. And you can see not only is it trading above 1 standard deviation at 189.07, it's also trading 2 standard deviations or above 2 standard deviations of 202.46. So that makes Apple extremely overvalued at current levels, and the risk is that it reverts back towards its fair value price of 175.68. And don't forget, Apple's already pulled back from the peak, so it's no wonder when Apple was really motoring and making new highs, Warren Buffett decided to trim some of that position, even though he likes the company. So we can see Warren Buffett is just being true to his value investing principles when he sells a stock that otherwise he actually quite likes. He's just seeing it become overvalued, he's trimming it, he's booking some profits. So now let's take the reverse of that and let's go and find some of the best stocks within his portfolio that is showing the opposite. In other words, undervalued stocks below their intrinsic or fair value prices that potentially offer some of the best returns to the upside. So if we look at his portfolio, one of the first things to note is the top 5 sectors that he's allocated into: financials, tech, consumer staples, energy, telecoms. Now, what this suggests, especially being so heavily invested into financials, is that Warren Buffett is anticipating those Fed rate cuts. He's looking for the 2-year yield to go down, and he's especially looking for the 2-year yield to go down relative to the long end of the US yield curve. In other words, he's expecting short-term interest rates to fall faster than long-term rates. So when we talk about short-term interest rates going down faster than long-term interest rates, we're talking about the yield curve in the US. And why is the yield curve important? Well, as this report from the RBA states, the yield curve receives a lot of attention from those who analyze the economy and financial markets. The yield curve is an important economic indicator because it is central to the transmission of monetary policy, a source of information about investors' expectations for future interest rates, economic growth, and inflation. So it's actually a leading indicator of the bond market. However, what we're interested in today is it's a determinant of the profitability of banks. As the report continues to show, the level and slope of the yield curve can also influence the profits of the banking sector, although its importance varies across economies. Profitable and stable banks support the growth of credit in the economy, which is an important factor for economic growth and in particular for investment. Profitable and stable banks also help reduce the risk of financial market disruptions in a crisis. Banks earn profit from lending funds at a higher interest rate than they pay to borrow funds from depositors and other sources. Banks usually lend for longer terms than they borrow, so part of this profit comes from the difference between long-term and short-term interest rates, i.e. the slope of the yield curve. If the yield curve is normal, all else equal, a steeper slope will mean a larger margin and higher profits for the banking system. So if you look at the 3 different types of yield curve, you can see you've got normal, flat, and inverted. And it's the normal yield curve where you see the shorter end of the yield curve lower down and the longer end of the yield curve higher up. In other words, it's upward sloping. This is where you tend to see banks in a higher profitability zone. Because if they're borrowing on the short end, they're paying less interest on the short end and they're making more money on the long end where they're lending the money in the form of, let's say, a mortgage. So if we go and have a look at the actual shape of the US yield curve today, you can see the opposite is the case. We have an inverted yield curve and we have short-term interest rates, you can see the 1 month of 5.49, higher than long-term interest rates of 4.12. So why would Warren Buffett invest in financials with an inverted yield curve? Because he's forwards looking here. He's looking ahead to future rate cuts, which will cause the yield curve to steepen. And this is why he's piling up on financials now, ahead of the anticipated rate cuts, where he expects financials to be one of the main beneficiaries of this. So now let's go and have a look at 2 of the top financial stocks in Warren Buffett's portfolio that are offering substantial discounts to their fair value. The first bank we're going to look at is Bank of America. Now, Bank of America had a daily close at the 38.81, and when we run the models on it, it has a fair value of 48.30. And what we're looking at here is we're not looking at stock which is 1 or 2 standard deviations below its fair value, but we do have a substantial discount currently to the fair value price of 48.30. In fact, we're roughly about 20% undervalued based on multiple financial models, and there's roughly a almost 24.5% increase from the 38.81 daily close to get back to its fair value. So we're not even looking here if the stock overshoots its fair value and trades into maybe 1 standard deviation above fair value at 66.89. We're simply talking about a 24 to 25% increase just to get back to fair value. And if we pull up a chart of Bank of America in the Hedge Dash platform, you can see we've got fair value of 48.30. And we have the one standard deviation to the downside, 29.71, and I've marked the 66.89, which is the one standard deviation to the upside. So in terms of Bank of America, you could see if fair value is at 48.30, we tested it and then we sold off. We became undervalued by one standard deviation. Look at this. So we trade below the 29.71. This is where we really start to get into undervalued territory. And then we start to break above and we start to head back towards fair value at the 48.30. Now you can also see technically not only is there roughly 24% upside from current prices, and of course if it pulls back a bit, there is more upside if you can get this at a better price. But you can see technically we've also broken out of this kind of double bottom. We broke the high, we confirmed this reversal pattern, we tested it. Now we're above the 200 moving average in the weekly and we've bounced off of it. Now if we drop down to the daily chart, you can see the 48.30 fair value level up here. And you can also see us bouncing along the 200 moving average. Now, interestingly, I've put on the quantitative levels. Many of you will know these from the weekly Forex forecast. Here are the monthly levels for Bank of America. We sold off. We traded below the monthly lower bound in the Hedge Dash quantitative trading platform, and we bounced. And that was the probable range. And these are the same levels, but on a monthly time horizon that we look at in the weekly Forex forecast videos. And when we bounced from here, where did we come to? We came to the weekly upper bound. So this week is not a fantastic place to buy because we're actually overbought intra-week. So I do think next week there's a good chance we could come down lower and we could very easily retest probably the 200 and also the monthly lower bound roughly at the 36.60. If we do pull back into this area, this is going to be setting up for roughly 30% upside back to fair value. The next financial stock we're going to look at is Citigroup. Now, Citigroup closed at 59.28. And when we run the models on it, its fair value is at 66.65. This is roughly 11% undervalued. However, it's about 12.5% back to the 59.28 close to its fair value. Again, we're not seeing any extreme undervalued readings because we're not below the first or second standard deviations to the downside at 50.23 or 33.81. But these readings would be rare anyway. They're not expected most of the time. And it really underscores how in Apple, being right above the second standard deviation to the upside above fair value, you can really understand why Warren Buffett trimmed some of that position in Apple. Okay, so if we have a look at Citigroup on the weekly chart, you can see we already came back and tested fair value at the 66.65. And remember, these levels, these are not technical or really quantitative. These are fundamental levels. These are levels and valuations based on the fundamental financial analysis of the business. Nothing to do with technical analysis, nothing to do with outperformance, underperformance, anything else. Purely based on the financials of the business. And you can see we get to 66.65 and we sell off from here. Now, we have already bounced and this has eaten into quite a bit of the distance between, roughly the 200 weekly moving average and fair value at 66.65. But there is, especially if we get a pullback here, there is quite a lot of upside, especially relative to a number of Warren Buffett's stocks, because not all of his stocks in his portfolio are very undervalued. A lot of them he's actually held on to the point of almost becoming overvalued. And then, I would assume he would be cutting some of the position like he has done with Apple. So if we drop down to the daily chart, again, you can just see I've got the one standard deviation to the downside. So the 50.23, if we do for whatever reason trade below that in the near future, this is an asset which is extremely undervalued fundamentally. But in the near term, especially as we're holding this 200 daily moving average, you can see I've put the monthly levels on here. We breached this, and what happened? We immediately reverted back inside within the same month. You see this again and again with these levels. And if I now add the weekly levels on, you can see we pretty much have a similar setup. We bounced in the monthly, we breached the lower bound in the monthly, tagged the 200 daily here, and now we've pushed back into the weekly upper bound. So again, is this a great place to buy? Well, if you get involved here, there's a good chance this pulls back, probably retest the 200 next week. And in that case, you're going to miss out on some downside. Remember the graph we looked at the beginning of the video. The higher price you pay for these stocks, the lower the forward return. So you really want to get these when they're selling off or on the down ticks as opposed to, trying to buy them as they're already rallying. So patience required in some of these. And if we do pull back, you could see really, a 15% plus upside from roughly the 200 moving average just to get back to fair value and prior highs in this asset. Now, if we go back and look at the portfolio, you can see the next top sector is tech. However, most of that is Apple, and we've just been through why Warren Buffett trimmed Apple. So we're going to move on to consumer staples. And we're going to look at two of my favorite value plays within the consumer staples weighting of Warren Buffett's portfolio. So my favorite one in this sector is Kroger. You can see it closed at 52.7, and we have a fair value at 64.58 after running the different models on it. And it's undervalued by about 18.5% roughly. But you've got an increase to its fair value from the closing price, 52.7, of around 22.5%. Again, unlike Apple, we don't see any extreme readings above 1 or 2 standard deviations, but we do have some substantial upside if this asset is going back to its fair value price of 64.58. So we've put up Kroger on the weekly chart, and I must admit, I love the look of this technically. We've had a really tight consolidation into the 200, and then we get momentum. Momentum precedes price. Really strong momentum breakout. We've pulled back. We've retested the breakout level. We also happen to test or retest the 49.08. This is 1 standard deviation to the downside. You can see this company has recently, very recently, been extremely undervalued. And it does look like after basing here that this is set for the next leg up. And to get back to the 64.58, especially if you start to pull back and sell off a bit, I mean, you could easily be looking at 25% plus upside just to get back to prior highs and fair value at the 64.58. This market is so nicely structured technically that I wouldn't be surprised to see this breaking past 64.58 and even making an attempt towards 1 standard deviation to the upside. That wouldn't surprise me at all, based on the fact that this is technically sound, based on the fact that we have about 25% upside to fair value. And if the US is going into a slowdown, consumer staples is one of those sectors that tends to benefit because it's a defensive sector. And traders, investors tend to rotate into defensive sectors when they think there's going to be a slowdown in the economy. And if we drop down onto the daily chart, you can see the probable range for August here. And if we pull back and breach this, especially as it intersects with 200, this would be a great place on the dip. Notice how this market, by the way, is currently testing its weekly lower bound. If you are going to time these kind of markets and step in, that is exactly where you would be looking to do it. Not like with the financials we looked at, where it's testing the upper bound, because you usually get involved and then it pulls back. This is the kind of sell-off pullback that you want to be looking at. And again, we already have roughly, 20 to 22% upside to fair value, pretty much from where we're at now. Any further downside next week just adds to that potential back to fair value at 64.58. And the second consumer staple stock in Warren Buffett's portfolio that I like is Kraft Heinz Company. Daily close at 34.49. Fair value sits at 39.31. So not as much upside as we just looked at in Kroger, but we do have a nice 14% increase to the fair value price of 39.31. So pulling up a weekly chart of Kraft Heinz Company, you can see we've recently been back below the 1 standard deviation, 32.93. So we start to trade below there. We're really getting into that kind of extreme undervaluation. And every time we've been past the 32.93, you can see we start to revert back towards fair value, And this market really has been chopping around fair value. So this is more of a range play. Unlike what we just looked at in Kroger, which is a really nice kind of trending breakout, kind of bases, corrects into the 200 moving average and then starts to break out again. We're really looking at a crisscrossing ranging market where every time it breaches the 32.93, it kind of ranges back towards 39.31. If we drop down to the daily, you can see we've nestled nicely into, not only are we gap closing over here, but we've nestled nicely into the weekly lower bound. So again, whether it's the weekly lower bound or the monthly lower bound, if you are using the hedge dash system, that is a good place to time any buying opportunities, buying on the dip, or if you're shorting, you short on the rip into the upper bounds. And we're going to finish off the video with 2 stocks from the energy sector. And the first one we're going to look at is Chevron. Now, Chevron had a daily close at 144.67 and fair value sits at 182.03. We have roughly 25% up to get back to fair value in this oil stock. And oil stocks was something I mentioned in the previous video, and Chevron was one that I highlighted did have risk for any kind of escalation in the Middle East. And I did highlight Oxy as a good stock to look at in the previous video. If you didn't see that video, don't worry, because it's going to be coming up next. And if we look at the weekly chart of Chevron, look at the technicals on this weekly chart. Not only are we consolidating and basing into the 200 weekly moving average, we've just put in an outside week, an engulfing week after trading below the one standard deviation undervalued level of 141.320. So not only is this technical support and the 200 moving average, but we're also seeing buyers come in because this market is becoming very, very undervalued. So the technicals here really speak for themselves, and we could very easily see this going back to prior highs, and there's possibly 30+% upside back to fair value and back into the prior highs in this asset. And if we drop down to the daily chart, you can see we came down and we tagged the weekly lower bound here at the 140.63, and we had this big reversal candle, and now we're making our way back up. So we're not quite near the weekly upper bound, so there is still room to go to the upside. However, you can see on a monthly time horizon, we're actually below the probable range of the 148.35. So we're still oversold intra-month for the month of August at current pricing at the 147.25. And the final stock we're going to look at in the energy sector and in today's video is Oxy. Now, Oxy is a stock we looked at previously for technical reasons, but fundamentally, this is a market that is also undervalued and setting up as a good value play within Warren Buffett's portfolio. You can see the daily close previously at the 56.94, fair value sits at 64.06. It's about 11% undervalued, but it's got roughly 12.5% upside. If we can get any pullback in this asset, you could be looking at roughly 15% upside back to fair value on any near-term pullback or sell-off. Dropping down to the weekly chart, and you can see the fair value at 64.06, the one standard deviation to the downside for fair value 52.93, where we really start to becoming undervalued below this level, and to the upside the 75.19, and this market has just been trading around its fair value. You can see that. So any sell-off in this asset, especially if we start to intersect the 200 moving average and we take out the 52.93, this would be an area where you would get some technical support here from the 200 weekly moving average. Again, you've broken above it in this asset, consolidated into it, and very often you see those breaking higher. So there's a technical pattern there overlaid onto the valuation metrics where we start to become very undervalued below 52.93 based on a number of financial models. And if we drop down to the daily chart, you can see the monthly lower bound for August at the 55.35. We already broke this and we immediately started to reverse. You can see that. So if we breach the 55.35 this month, we start to become oversold intra-month. And of course, if we push further down back into the 52.93, we start to become really undervalued in this stock, fundamentally speaking. So anywhere between the 55.35 and the 52.93, you're probably looking, when all is said and done, between 15 and 20% upside back towards fair value at the 64.06. So that is it from me for today, guys. As always, I hope you enjoyed today's video. And if you did, why not consider joining us in the GMT training room each day, where I look at the best markets, as well as sharing real-time setups that I'm personally looking at trading with members as part of our GMT training program. Don't forget, you can also get a 2-week free trial to the cutting-edge Hedge-Trading app used in today's video by heading over to www.hedge-.com. Access to the cutting-edge Hedge- platform is included with every GMT membership.